Hello friends. Why companies issue shares instead of taking loans? Let's discuss that today. Stock market is a place where companies sell their shares and investors invest in the company by buying those shares, right? When companies need money to extend their business, they have two options. One is taking loans from banks or private institutions, and the second one is issuing shares to public. Let's discuss each in detail. First one is loans. Assume a company called ABC took loan of 1 crore from a bank with interest rate of 10%. If the company wants to expand business, obviously it requires huge amount, right? That's why I said one loan amount as 1 crore. For 1 crore, yearly company has to pay 10 lakhs as interest. That means 83,000 roughly per month. If the company is in profits, it's not a big issue. Since it's a new business idea, it will take some time to be in profits, right? Even if it is in loss or not getting profits, then also they have to pay interest irrespective of their conditions, right? Not only interest, but initial amount also will be there. Also, it has to keep something as collateral to get loans. But assume the company issued shares. It doesn't has to put any collaterals. It doesn't has to pay anything to shareholders during profit or loss. If the company is in profits, share value will increase. If not, share value will decrease. There is no burden on the company. There are some companies who will pay part of their profits to shareholders as dividends, but it is optional. So while issuing the shares, companies are reducing their risk. That means they will share their risk to investors. Now you will have a doubt. If the companies are issuing shares, who will get the money? Let's see that. Assume two friends named X and Y started a company. At the time of starting, they divided the shares into three parts. Two for friends and one for company. Even though company is not a human being, it has its own shares. Issuing shares to public means they are issuing shares of the company to public. Assume the company is worth 1 crore with 1 crore shares. Each share will be 1 rupee, right? This is called face value. Out of 1 crore shares, assume two friends will have 70% each. 70%, which is 35% each. Remaining 30%, that is 30 lakh shares, belong to company. X and Y can decide how many shares of the company to issue to public. Assume they issued 10 lakh shares to public. So the company will have 20 lakh shares which they can issue later or keep it with the company. Money which they will get from issuing 10 lakh shares to public will belong to the company. That will be used for business expansion. Once company issued shares to public, it will become public company. Public companies can have thousands of shareholders and apply strict rules and regulations. They must have a board of directors and should submit financial statements, that is quarterly and annual results. Also, it has to maintain transparency in all the information related to the company. To issue shares to public, company has to follow different procedures and should get permissions from SEBI, Securities and Exchange Board of India. SEBI is a regulatory body which monitors and regulates the securities market and protects the interest of investors by enforcing certain rules and regulations. The process of issuing to public for the first time is called IPO, which is initial public offering. Company, company will specify the price band, for example 50 to 55. Investors can bid their price in this price band from 50 to 55. Based on the demand, the company will fix the specific price and will issue the shares. This is called primary market. Once this process is completed, company will list in the stock exchanges like NSE and BSE for trading, which is called secondary market. Investors who bought the shares in primary market can sell their shares in the secondary market. Now let's discuss what is FPO. In our previous example, company issued only 10% of shares to public, right? That means it has 20% more remaining to itself. So if they want to collect more money for business expansion, again they can issue company shares to public by following the same initial process. This is called FPO, follow on public offer. If promoters or founders of the company wants to sell their shares, that process is called OFS, offer on sale. In earlier example, X and Y, the people who started the company has 35% of shares each, right? If they want to sell their shares, they need to follow the process called OFS, offer on sale. That's it for today, guys. We'll talk about different types of investors, regulators, brokers, DPs, and many more interesting topics in our next video. Stay tuned. Thank you.